The best performing assets have been gold and silver. The world has been in a deflation price-wise versus gold and silver since the bottom in 2000. If you hold gold, if you hold silver, you're going to be like a bank because these governments are telling you that gold is money. They're just now telling you that silver's money. So if it's money, they can't bankrupt. That's where you want your capital.
Yeah, gold is going higher, 5,000, 6,000, something like that this year. Not entirely unreasonable, but I'm not selling my silver. I mean, why should I sell it? I'm holding it as an asset, not as a speculative device. So is it going to 100 or 200? Yeah, it's possible.
In this compelling precious metals discussion, Bill Holter and Doug Casey outline why gold and silver continue to outperform nearly every major asset class and why their upside may be far from over. They explain that when priced against gold and silver, the global economy has effectively experienced long-term deflation since the early 2000s. Holding physical metals, they argue, is increasingly similar to operating outside the fragile banking system, because gold and silver function as money, not debt. They highlight that governments themselves are reinforcing this reality by openly recognizing gold as money and increasingly acknowledging silver's monetary role. If an asset is money, it cannot be printed into oblivion or bankrupted, making it a powerful tool for preserving capital during systemic stress. Clear price predictions are also discussed. Gold reaching the $5,000, $6,000 range within the current cycle is described as realistic rather than extreme, given ongoing currency debasement and sovereign debt risks. Silver, viewed as both a monetary metal and a speculative asset, carries even greater upside potential, with scenarios that could push prices toward $100 or even $200. The conclusion is direct. Gold and silver are not trades to flip. They are strategic assets for a rapidly changing financial world. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
Central banks have been the buyers of gold by the official numbers, which are not always reliable, but still they're indicative, for years. Why? Because these central banks have assets. What kind of assets? Well, mainly it's been U.S. dollars. They don't want to hold U.S. dollars. The U.S. dollar is the unsecured liability of a bankrupt government. So what are they going to hold for assets? Well, they don't want to hold each other's currencies either. So what else can they? Gold. That's what they've been doing, is buying gold. And I think that the price of gold is going to have to go a lot higher just to get rid of all the dollars that these central banks have. The public is not involved in gold at all yet, at all. So this gold bull market is coming from a whole different sector than past ones have. And at some point, the public will get involved.
Everybody's worried about price. Forget about price. The bottom line is, do you own it or do you not? How many ounces do you have? You're going to count your net worth in the future in ounces, not dollars, not yen, not euros. You're going to count your net worth in ounces. So price does not matter, because silver is going to go through a failure to deliver. And when that happens, you either own silver and have it, or you don't. You're either in or you're out. And if you're out, you'll never be able to get back in. You'll never be able to get in. There won't be physical metal for you to buy with fiat. Fiat is not going to be accepted for physical metal. So don't worry about price. Just get capital out of the system into metal. Metal can't bankrupt. The system is bankrupting. The paper markets are becoming irrelevant, if you will. I mean, you've got $75 silver in New York, in London, yet you've got $80+ silver in Shanghai, higher in Japan, higher in UAE, Dubai, all over the world. The physical market is trading above the cash market. Above the futures market, the paper markets. When a spot price trades above the futures price, it's called backwardation. That should never happen, because how could an ounce of gold be valued today less in the future than it is today? It can't be, because there has to be some time value of money. So that's a very rare occurrence. But what you're having happen now is you've got backwardation between markets themselves. The cash markets are trading above the futures markets, the paper markets, and that's people, investors, buyers. This is not about stackers. Silver, the big demand is coming from industrial use. But the point I'm trying to make is you have the paper markets and the physical markets separating. If you want to call that backwardation, you can call it backwardation. But what it tells me is that the paper markets in short order are going to become irrelevant. Squeeze that looks toward price. So have we been in a squeeze? Yeah, absolutely. The price is going higher. But the danger is that there's more delivery demands than there are ounces in inventory to deliver. And that failure to deliver, COMEX will issue force majeure. They'll pay people in cash. That way they can say, no, we didn't default. But make no mistake, it is a default. If you bought a silver contract with the expectation that you could stand for delivery, get the metal, and you don't get the metal, that's a default. They're from a technical standpoint, they can legally say it's not a default, but in the real world, that's a default if you don't get your metal.
In this in-depth precious metals analysis, the veteran macro market analyst explains why central banks have been aggressively accumulating gold for years, and why this trend signals much higher prices ahead. According to official data, central banks have been persistent buyers as they steadily reduce exposure to US dollars, which are increasingly viewed as unsecured liabilities of an over-leveraged system. With little appetite for holding one another's currencies, gold has become the neutral reserve asset of choice. The discussion emphasizes that the current gold bull market is fundamentally different from previous cycles. This rally is not being driven by retail investors or speculative mania. Instead, it is fueled by sovereign institutions repositioning away from fiat risk. The public has barely participated so far, suggesting the move is still in its early stages. When public demand eventually enters the market, the pressure on supply could intensify dramatically. Silver is highlighted as facing an even more fragile setup. Physical silver is already trading at premiums across global markets, with prices in Asia and the Middle East exceeding Western paper prices, an unusual condition known as backwardation. This divergence points to a growing disconnect between paper contracts and real metal availability. The thing is clear: if delivery demands overwhelm inventories, exchanges may resort to cash settlement, effectively admitting a failure to deliver physical metal. At that point, price becomes irrelevant. Ownership is everything. Now let's get into the interview.
Silver people are like a special class of people. The people have always believed in silver. You're not supposed to believe in an investment, okay? It's like you don't love anything that can't love you back. Silver's like that. Anyway, answer to the question is I've always been friendly towards silver for various different reasons. I own a whole bunch of it. I've accumulated it over the years in cash form, physical form. Only problem with silver is that if you're going to have enough of it to be of real value, you got to find some place to store it. I mean, it's heavy, bulky stuff. So answering the question, look, silver, it's the most reflective, the most conductive, both electrically and heat-wise, of all the naturally occurring elements. That naturally makes it a high-tech element. Another point of view that you might bear in mind is that the annual production of silver is trivial in dollar terms, even relative to gold. The demand for silver every year is These numbers are very flexible as far as what they count in what column and where it comes from and all this. But let's say there's 1 billion ounces of silver that are demanded by the market, but there's only 200 million ounces of the stuff that's mined every year. And there used to be huge inventories of silver. The U.S. government once owned 2 billion ounces of silver and all the silver in coins before 1965. It's all gone. I mean, it doesn't exist. There are no big hoards of silver anymore. And because of its unique chemical properties, silver's kind of coming into its own as a high-tech metal. So, answer to the question, is silver at a new high where it's going to stay there? Yeah, very possibly.
In this closing segment of the discussion, the focus turns to why silver continues to attract a uniquely committed group of investors, and why that conviction may finally be justified by fundamentals. Silver has long inspired belief rather than simple speculation, but the argument here is grounded in hard realities of supply, demand, and utility. Unlike many assets, silver plays a critical role in modern technology due to its unmatched electrical and thermal conductivity, and its status as the most reflective metal on Earth. These properties make it indispensable in high-tech and industrial applications, not optional. What makes the setup even more compelling is the imbalance between supply and demand. Annual global silver demand is often estimated near 1 billion ounces, while mined supply covers only a fraction of that. In the past, above-ground inventories filled the gap, but those stockpiles are gone. Governments once held massive reserves, including billions of ounces, yet decades of drawdowns have exhausted them. There are no large strategic hoards left to stabilize the market. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.